The global market sell off today is no less than a historic meltdown for global equity markets across the world. We saw a US market sell off, followed by Asian market slump, and then Indian markets extend that decline as well. Now, to decode the global market crash, I'm joined by Sanchita Mukherjee, senior business economist, as well as managing partner of Talk the Walk. I'm also joined by G. Chokalingam. He is the founder of Economics, as well as a market veteran. Thank you both very much for your time. First to you, Sanchita. What really led to this massive sell off today? Many saying, is it just US investors reacting to the weak US economic data, or is it them reacting to the Fed indication of the rate cut in September, or the surprise move from Japan's central bank?
Thank you so much for having me here, Sakshi. It's always a pleasure to be here. As you rightfully mentioned, today's meltdown is purely because of global reasons, primarily being there is a doubt amongst global investors whether US economy is having a soft landing or a hard landing in terms of recessionary fears. And there is also a fear in the equity markets whether the Federal Reserve is actually behind the curve in terms of should they have cut the interest rates sooner. So there is a lot of fear in global investors in terms of where US economy is actually headed. Are these recessionary fears blown, and why has this suddenly come about? I mean, the Federal Reserve has actually indicated a September rate cut. So by that logic, markets should have been ideally rallying. So why is there so much of a fear? The fear is that it might be a bit too late for the Federal Reserve, is what the markets are reading, because they feel that the unemployment data, which has come, is one of the highest. The average wage increases have been one of the lowest for a very long time. Private sector jobs have been one of the lowest for a very long time. So they feel, along with the elections coming up in US, all of this data is not sounding to be a very sound landing for the economy. They feel maybe the recessionary fears might get blown, and the Fed possibly needs to aggressively now go about with a rate cut. So that's the primary reason. The reason why Indian markets have corrected is not so much as to do with the domestic economies, for sure. But having said that, domestic valuations in the capital markets are also stretched. It's not that they're inexpensive at this point in time. Most of the sectors in the Indian capital markets are stretched in terms of valuations, and there's a concern that the economy is also slowing down. There's been some data which has been published by Care Ratings on their CEM monitor, which is the Care Edge Economic Monitoring Meter, which is a composite index of how the economy is doing on a real time basis, and it has slowed in the last 6 months. So, yes, with respect to the Indian capital markets, valuations are a concern as well.
Right, Mr. G. Chokalingam, do you agree? What really is the factor for the massive sell off today in Indian markets, Asian markets, as well as European and US markets?
Yeah, most of the points she made are absolutely right, no doubt about it. There is a fear of recession entering U.S. economy, and there is a fear that U.S. Fed has delayed the rate cut. The experts believe that they should have cut the rate much earlier, and also the political tensions we are seeing in the Middle East, that is also contributing. On the domestic front, there are not many negative news actually. The monsoon has become surplus now, and currently GDP growth the forecast remains robust. So, according to me, the global weakness is due to the global factors. We are also impacted, but I have one more reason that it is. She also mentioned that, according to me, the major dominating reason is the valuation. More than 4,000 stocks out of 4,500 stocks traded, I don't find comfortable valuation at all, particularly in small and mid caps. So
Right.
something else also happened, small news, that would have triggered this market fall. So it was waiting to happen because the world economy markets have seen this Japanese carry trade, happening once in a while and hitting the market and then balancing being found. But according to me, among all, these are all causes, but the real cause is lack of valuation comfort in 8 out of 10 listed stocks in the market.
Right. And for those wondering and those sitting at home, Sanchita saying that, look, are these recession fears here to stay? What would you say?
Very
Uh,
valid question. Sorry, would you like to take that?
no, no, you can answer definitely.
So for everyone who are for investors who are investing in domestic markets, for example, I'm not an investment advisor, not an investment advice, but having said that, the story, the economic growth story and the capital market story in India remains very strong and very bullish on a long term. I completely agree with sir over here when he rightfully said that there's nothing astounding as such within Indian economics and Indian equities per se, apart from valuation concerns, which are definitely there, which are a bit stretched, especially in the small and mid caps. So, if there is volatility which is happening in terms of US markets led, in terms of US recessionary concerns, global concerns, oil concerns, whatever is the concern. For Indian investors, I think they should just stay the course. Definitely consult with an investment advisor in terms of sectoral valuations, which sectors, have a look individually at their own risk return portfolios, profiles, and then take a call.
I
Right,
just want
Mr. G.
to add,
Chokalingam, do you agree? What do you feel? Should, is this here to stay? These fears that have resurfaced now, are they here to stay? The recession fears.
yeah, I agree. I want to add only one more point. Very interesting insight which I learned in the last 20 years of ups and downfall in the market, global markets. The recession fear is there. Let me tell you, the Indian investors need not worry about recession fear in the developed world. Their pain is a gain for us. It was repeatedly proven in 2007, 8, 2016, in Corona time when everybody was affected. That time also it was proven how the pain in the Western world, the first thing to happen, rate cut, second thing to happen, oil price crash. Both are positive for Indian markets. It happened repeatedly in the past 2 decades. So what would mean the fall in the interest rate would induce a lot more money to come from the Western world to Indian markets, and two, oil price will crash. That will be the biggest trigger for Indian market and economy because your inflation rate will come down, forex reserves will go up, rupee exchange rate will improve, and therefore all these foreigners would find more attraction in the Indian equities. So
Right.
therefore, the taking point is do not worry about the global factors, these ups and downs. Always be confident of the valuation of the individual stocks you buy and stay invested for long term. So those who buy today also they remaining out of remaining 20% are quality stocks in terms of management balance sheet and valuation comfort, certain to make a lot of money. So do not worry about it. Improve your skill set in selecting the individual small and mid cap stocks.
Okay, but for those sitting at home or those investors saying that, look, all along we've been saying that India's economic fundamentals are strong, are outperforming, but going forward, how resilient can Indian markets be to geopolitical tensions, to, of course, what is happening with global cues, US investors reacting on those recession fears? Mr. G. Chokalingam, what do you have to say to them?
See, according to me, I may be wrong. The major war is ruled out. Only the proxy wars can happen. The bigger countries playing, managing this war through small countries, because everybody is sitting on bomb. All major economies in the world. So I don't think there is going to be a full-fledged war because that will be end of the world, and then we don't have to worry about the stock market also. So I don't have much worry, but a localized war, if it is going to create a bubble in the oil price, yes, whatever I mentioned earlier, the reverse would happen. The rupee will depreciate, forex reserves will deplete, the inflation will come in, and then market will crash. So you need to watch out this global political tension along with the oil price. And interestingly, despite a lot of tension in the last 6 months, oil price has corrected year on year about 9%, and within 1 month peak, it has fallen even 11, 12%. So therefore, I would not give too much importance unless India also forced to involve in the war or the oil price shoots up. So these are the only two things. Otherwise, don't worry much about the war front as well.
Right, Sanchita, would you agree that we need to be in wait and watch mode? Of course, we have been saying that, look, India's economic fundamentals are strong, but just how resilient can Indian markets be or the Indian economy be to what's happening in the rest of the world?
I completely agree with both you, Sakshi and Sir. What he said was very, very valid because, in a world which is where India's shining story is very, very stark, let's understand that the only drawback that India faces with global investors is the oil. That's the joker in the pack. So, any indicator that oil prices are here to stay lower is actually net positive for the markets in the long run. This is not a market which is good for speculation and traders as such. But for investors, long-term investors, they can definitely use this volatility as a friend, provided they understand and they are able to weather short-term volatility, because short-term volatility might happen because of various factors, primarily global. Having said that, the Indian markets are very, very resilient. And if the oil prices were to stay low, it is a huge plus for our economy as such, in which case investors can actually use this to their benefit.
Right. And Mr. G. Chokalingam, to those saying that, okay, then what sectors or what stocks can outperform in the near term and the long term, what would you say?
Certainly, you should focus 50-60% of your equity asset should be in the large cap for time being. Of course, in the long term, only small and mid cap will create a lot of wealth. So, if you ask me the sector, to some extent, still banking sector is a play, though the credit growth rate has come down by about 250 basis point. Still, the business is growing in double digit. Credit is growing close to 14%. That is one sector. And second, carefully chosen infrastructure stock sector, because two-thirds of the stocks they are also overvalued, but some index stocks are still preferable, because both Sensex and Nifty they trade around 24 times the profit of those indices, whereas small caps are trading at 30, still 34 35 times. So second is the infra, and third the pharma stocks. Because of this concern in the short term on market stability and political tension, the pharma sector also would continue to help in protecting your wealth and growing. So these are the three sectors I would name.
Right. And Sanchita, which sectors would you feel will outperform given what's happening in the rest of the world in the near term and in the long term?
Thanks, Akshay. I'm not a specialist as Sir is, but I completely agree with him. In this kind of a market where most of the sectors are looking a little overvalued because of the run up, and we are clearly seeing a lot of profit booking happening in certain PSU counters, certain defense stocks, and certain PSU banking and certain energy stocks and all of that. One can definitely play a little defensively, a little cautiously, again based on one's own risk return expectation. In which case, pharma, healthcare looks good, IT in pockets look good. Let's understand, in spite of the global slowdown, India still managed to keep up its exports quite well. In fact, compared to the Eurozone, India's export sector, some of the definitive export sectors where like electronics and all are doing really well. So some sectors like that, which are have come up the curve in the last 5 years, and valuations have still not run up. One could look at that.
All right. Thank you so much, both of you, for sharing your insights. And we will, of course, continue to track the Indian markets as well as global markets and how they're reacting to all that is happening around us.
Thank you.
Thank you.